Well, basically, at the present time, about half of all sovereign bonds yield less than 1%. And in Europe, we have next to zero interest rates in some countries. And what is also interesting is that the sovereign bonds, the 10 years paper of Portugal, Italy, France, and Spain all yield less than 10 years US Treasury notes. So, in other words, the policies of central banks have grossly distorted financial markets and misallocated capital, in my opinion. That's why I said, and I have to rectify you about this point. The last time you interviewed me, I said that in Europe I would see better performance of equities because many equities yield, say, 5 times more than sovereign bonds, whereas in the US, the S&P and the 10 years Treasury note have about an equal yield. So I think that actually this year, European stocks, unhedged, could outperform the US.
Unhedged, sure, but if you are a U.S. investor who is investing with dollars, you're looking at much different returns. And Mark, if you're simply looking at the
yes, you're looking at different returns. Since the beginning of the year, if you invested in German stocks in the DAX and you didn't hedge, you were up 5%. Seems to me a different return from the S&P, which is basically flat.
This is true. However, when you start looking at some of the volatility and whether or not investors are willing to take a risk on that, let's just assume that the Fed does go ahead and start raising interest rates as early as June. If that happens, what does that do to markets around the world? What does it do to stocks in the United States? And what does it do to other stock markets?
In my view, it wouldn't be tragic for U.S. stocks. I think the financial markets will run or move according to lots of different factors, not just the Fed. Before you discussed what happened in 1937, yes, it's correct. It wasn't just the increase in rates that essentially led to stocks coming off again. In this particular instance, I have to say the Fed and other central banks would have to increase interest rates quite substantially to really knock off stock markets. But there is one point I'd like to make. In my view, the Fed will not increase interest rates this year, A, because of the dollar strength, and B, because the recent economic data has rather been disappointing and the economy is simply not taking off. So I don't see there will be an interest rate increase.